On June 12, 2026, SpaceX went public. The stock opened at $150, jumped to $225 within days, and made thousands of employees paper-rich in a single week. And almost none of them can actually sell. Not because they're choosing to wait, because the company built a structure that decides for them a staggered schedule stretched out over 6 months, with one date in the middle of it that matters more than any other. That date isn't in December, when the lockup fully ends. It's not the IPO date either. It's a date most people watching this stock have never heard of, and by the end of this video, you'll understand why it might matter more than the stock price itself. This wasn't a normal IPO. SpaceX priced shares at $135, and by the end of its first day of trading, the stock had jumped nearly 20%, closing around $161. Within days, it touched $225 before pulling back into the $170-$200 range. At a market cap north of $2 trillion, this was one of the largest public debuts in history. Thousands of SpaceX employees are now sitting on paper fortunes. Some hold a few $100,000 in stock. A smaller group holds enough to change their family's financial trajectory for generations. But here's what almost none of the coverage explains. Most of that stock is currently untouchable. Only a small slice of total shares, reportedly around 4%, was actually available to trade on day one. The other 96% belongs to founders, early investors, and employees who are locked out of selling under restrictions that were written into the deal before the stock ever opened. That's the lockup period. And this one isn't a simple 6-month wait. Most people assume a lockup works like a light switch, restricted, then unrestricted on one specific day. SpaceX's structure doesn't work that way. Instead, it releases in stages. The first meaningful window opens after SpaceX reports Q2 earnings, when roughly 20% of locked shares become eligible for sale. There's also a performance-linked bonus tranche, an additional slice of shares that unlocks early, but only if the stock trades meaningfully above its IPO price in the days leading into that earnings report. If the stock doesn't hold that level, that portion rolls into the later release dates instead. After that, shares trickle out in smaller staggered chunks at set intervals, roughly 70, 90, 105. And 120 days after the IPO, with a final larger release tied to Q3 earnings. The lockup doesn't fully expire until around 6 months out, in mid-December. So instead of one flood of selling on one day, SpaceX built something closer to a series of valves opening one at a time. That matters because it changes how employees think about their stock and what outside investors should actually be watching for. Even employees who clear one of these early release windows aren't necessarily selling right away. Here's why. A lot of SpaceX equity is held as restricted stock units that vest over time. For many employees, vesting has already occurred over years, meaning shares have been settling and being taxed along the way, long before the IPO. For those employees, the IPO doesn't create a sudden new tax event. It creates something arguably more stressful: liquidity without full freedom. The taxes on vested shares may already be owed, but the lockup still determines when those shares can actually be converted to cash. That mismatch owing tax on value you can't yet access is one of the quiet pressures sitting underneath this entire story. It's part of why financial advisors who specialize in pre-IPO equity describe this period as one of the most stressful financial windows of an employee's career, even when the number on their screen is enormous. On top of that, ordinary income tax rates apply differently depending on exactly how and when shares were acquired and sold. For employees holding shares tied to specific exercise or settlement dates, the difference between selling slightly early and waiting past a 1-year holding mark can mean a materially lower tax rate on any gain. That single distinction, short-term versus long-term treatment, can be worth a significant chunk of an employee's total payout, depending on their specific equity mix. It's not a universal day 365 rule for every employee at the company. But for a meaningful share of them, the math is real. And it's one more reason the selling doesn't happen all at once. Here's what doesn't happen. Thousands of employees hitting sell on the same morning, crashing the stock in a single dramatic moment. What tends to happen instead is quieter. Executives and senior employees often set up pre-scheduled, automated selling plans months arrangements that gradually execute trades over weeks rather than all at once. These plans exist partly for legal protection around insider trading rules, and partly because dumping a large position into a thin market all at once tends to hurt the seller more than it helps. So the pressure doesn't arrive like a wave. It arrives more like a tide building gradually as each staggered release window opens, as more shares become eligible, and as more of those automated plans start executing in the background. Already, analysts tracking the stock have flagged this dynamic directly. With only a small float trading freely so far, SPCX has shown unusually sharp price swings, surging over 65% from its IPO price within days, then pulling back just as fast. One former Nasdaq executive has publicly noted that the stock is currently trading more on sentiment and momentum than on underlying fundamentals, in part because so little of the company's total share count is yet in play. So what does this mean if you're watching SpaceX from the outside, not holding employee shares? It doesn't mean a crash is coming on a specific date. It means a small fraction of total ownership is setting the price you're seeing right now, and that fraction is set to grow in stages between now and December. Two things are worth tracking. First, trading volume around each release window: Q2 earnings, the staggered post-IPO dates, and Q3 earnings. Not a single spike, but a sustained rise that holds for days afterward. That's the signal that newly eligible shares are actually entering the market, not just becoming technically available. Second, watch the float itself. As more shares unlock, the pool of tradable stock grows, and a stock that's been moving on thin trading and heavy sentiment tends to behave differently once more real ownership has a say in the price. That's not a prediction that the stock will fall. It's a reminder that the price today is an opinion formed by a small slice of the company's owners, and a much larger slice hasn't weighed in yet. There's no single dramatic day coming. No headline moment where it all unlocks at once. Just a staggered series of dates, quietly built into the deal from day one, each one releasing a little more of the company into public hands. The employees who built this company are watching those dates closely. Now you know what they're watching for too. If this breakdown helped you see the stock differently, subscribe. Every week I break down what's actually happening underneath the headlines. And I always leave you with something concrete to watch for next.